Hello there, Wealth Press viewers. Welcome to a happy Wednesday, and it's the midweek update. And I'm here with Lance Ippolito to talk about the market. Lance, welcome.
Hey James, how are you today?
I am feeling good, thanks. Let's start with a discussion about the Dow dumped 200 points this morning based on fears, I guess, of coronavirus infection rates increasing in some states. Is that something that is affecting your trading activity today?
Yes, so actually, uh, p- today's the first day. Apparently, Mr. Market cares about new cases. For the past really week, we've been ignoring the rise in new cases of the coronavirus, and it seemed that it no longer mattered to Mr. Market. And today, you're finally seeing some volatility come in the markets, and even technology. Which has been leading the way, especially the Nasdaq, is getting hit today. So a little bit of a shocker, but I think it's healthy for the market, and the market has been so disconnected from the economy that having some connection would be, in my opinion, beneficial.
Sure. We're also coming up to the end of Q2 on
Yep.
January 30th, which is typically a major liquidity event in terms of some stocks getting dumped and other ones being accumulated. What's your anticipation of the sell-off that we can expect to coincide with June 30th?
Well, you make a good point. If you're a money manager and you've caught such a massive run up, and especially technology names, it's hard to argue. How do you not trim some? And that's what I'm seeing today when I look at specifically the FANG names. Your Facebook, Amazon, Apple, and such like that. They are starting to get liquidated. So you could be seeing money managers actually, doing exactly what you mentioned, trimming some profits and having that rotation. Again, I think it's healthy. We need to see red days, down days.
Sure. The A lot of the cruise ship lines were downgraded yesterday, and so there's a bit of a sell-off in that sector. Is that consistent with your expectations, and does that perhaps represent an opportunity to buy some of the cheaper ones?
I don't want to buy them yet necessarily. I think they've had a large run up, the cruise and airliners, then they've uh, reverted back down. I'm glad to see the analysts are actually coming out and giving realistic expectations on some of these cruise liners and downgrading them. I mean, they just came out the other week saying they're not going to have cruises out at least till September. So I still think there's room to the downside um, on these cruise liners, and with the rise of the uh, coronavirus cases, I think it's a dice roll still trying to pick a bottom, so to speak, in the cruise liners right now.
Okay. Interesting. The airlines also
Yeah,
not
same camp. You know, I, they are the airliners. They don't have the liquidity and the resources that a tech name can have, a tech stock can have. You know what I mean? When they're borrowing money and they continue to borrow, keep doing offerings and raising capital, they're doing it at a higher rate than, let's say, an Apple or Facebook. That are doing it virtually free. Um, you're playing with fire, in my opinion, trying to dip by cruise and airline stocks here.
right. Okay, so where are the stronger opportunities on the upside?
Something that's boring, and I know Roger has been talking about these names here, are utilities. You can look at the XLUs, the ETF.
Yep.
Like again, they normally don't move crazy, but they're high dividend yields, and in times of volatility, they tend to outperform. I also like the gold and silver miners. Um, Gold's been just on a tear to the upside, and some of these lower priced gold and silver miners, or if you don't want to pick an individual stock, you can look at GDX, GDXJ, the ETFs. But I like them. With the Fed and central banks kind of being reckless, how can you not have a position or at least consider those precious metals?
Right. I was reading a report today suggesting that the gold demand for physical gold in jewelry is dramatically down, like by 22% expected this quarter because of coronavirus shutting in the, closing down weddings,
Right.
people postponing marriages, all of the usual catalysts that drive gold buying for jewelry are, having that effect on the demand side, to the point where this was from a report by Metal Report is the name of the publication, which I've not heard of, but they were suggesting that the absence of demand in the jewelry market was going to be sufficient to counteract the investment demand on the ETF side, and that we could expect to see gold sort of sail sideways for the rest of 2020 in the $1,700 range.
Yeah, I when you talked about the demand for gold, at least when people think of the jewelry point of view, I mean, if you look at a jewelry store like Sig Jewelers, they just came out and said they're closing. I forgot what number was specifically, but they're out closing stores. So people getting married, buying anniversary stuff like that. Obviously, if they can't go to the mall or Sig Jewelers to go buy it, obviously that's going to weigh on that side of it. But I see it firsthand, and just some of the people I speak with, that physical gold, when you do have panic and fear in markets and in the economy, that really drives up that physical demand gold, and people will pay a premium for it.
Mm-hmm. Yeah, the poor cousin of gold, silver, has also been experiencing unprecedented demand as a result of the quantitative easing. But the Fed has now sort of pulled in its horns in terms of that, and is perceived to have front loaded the quantitative easing thing. And even last week, the Fed shed $74 billion in assets, suggesting that they are already moving to lighten the balance sheet, which it strikes me as intriguing. So on the one hand, they're buying corporate bonds. On the other hand, they're lightening up on treasuries. And it's kind of like, so they're robbing Peter to pay Paul, sort of thing. And I'm trying to put my finger on the macro sort of effect of that. And I think I imagine that it's designed to keep demand for stocks high with low interest rates, so people can borrow money and spend it on stocks that will still perform, now that the Fed has, instead of being the last sort of lender of last resort, they become the lender of first resort now in many respects. And it's like, okay, what does this mean? We're nationalizing the economy of the United States incrementally, and so therefore we should buy the stocks because the Fed will never foreclose on its covenants. And it's very confusing. So what do you make of all that?
I think they were forced to buy those government bonds, and we saw that news. It was about a week after the FOMC meeting when the market took a big hit. I think they were forced, therefore, to, when they do purchase it, to provide liquidity and basically boost stock prices. And if you look at the result market since the announcement, the market went vertical, a big to the upside. So I think, you're really playing, the Fed is really playing with fire here. And it seems like they're going to continue, just judging by some of the commentary coming out from, the politicians in the administration, that they'll continue to use their tools to prop up the stock market.
Hmm.
But,
So,
I also understand and take a step back and think, well, uh, what is the negative to this, right? What is the backlash? What's going to be the result of this recklessness, we'll say? And yeah, if it's scary to think, if we do see something come out of it, what's going to happen? A lot of unknowns. I will admit. So I'm definitely trading smaller, and I also always have in back of my mind that any day we could wake up and see the market down 2,000 points in the Dow, or limit down, and I know we can go back to that, like we did multiple times in March. So far we haven't, thankfully, but I know that can happen. So I cannot be one of these like Robin Hood traders who are like, hey, I'm going all in on stocks. I think that is just a bad risk management plan. And when you're trading and investing, everything is risk management.
hmm right. Yeah. So then, in terms of the strategies that you are looking at this week, or that you are seeing some success with, what is the main nature of those?
I like having, and what I'll continue to have is longs and shorts. So I'll have longs via
Hmm.
call options, and I'll have shorts via put options. Um, if you're not an options trader, it's basically the same thing of having a diverse portfolio. Having, long stocks or short stocks, or long stocks and long volatility products, or, even metals. Um, I'll continue to trade that way. So if the market goes up, I make money on the longs. I lose money on my shorts. And if the market goes down, I'm going to lose money on my shorts, or I'm going to lose money on my longs, but I'll make money on my shorts at hopefully a greater percentage return than if I was unhedged, we'll say.
Well, that's a great update, Lance. Let's leave it there for now. Thank you very much for your time today, and we'll talk to you then on the roundtable on Monday.
Thank you, James. Always great chatting with you.